It's time for Yahoo Finance's Market Minute. U.S. stocks trading in the green after bouncing off lows. The major averages seen losses in early trading after the OECD cut its U.S. and global growth forecasts, citing the potential impact of tariffs. Investors now hoping for updates on potential U.S. trade deals as soon as tomorrow. Meantime, shares of Constellation Energy rising as Meta signs a 20-year agreement to buy its nuclear power to fuel its AI ambitions. Meta will begin buying from Constellation's struggling Illinois plant in June of 2027. And Dollar General shares pushing higher after the discount retailer topped estimates in Q1, reporting strong same-store sales growth and lifting its full-year guidance. Dollar General's CEO saying the company is uniquely positioned to serve customers in the current economic backdrop. The company still warning of the potential impact of tariffs. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. On today's show, Portfolio Checkup. One portfolio manager discusses how to position in today's market, comparing defensive names to cyclicals. We'll get into that. And the Trump administration is pausing plans to cut Social Security benefits for borrowers with defaulted student loans, but they're going forward with wage reductions. We'll explain. Plus, the savings mistakes that are stopping you from building wealth. We'll dive into those. We got a lot to get to in this hour. But first, let's take a look at some of the market action. We're 90 minutes into the trading day. Stocks a little changed right now, but fractional gains for the S&P 500 and the NASDAQ. Investors await more clarity on trade policy. Don't hold your breath. My next guest, maintaining exposure to defensive sectors with low volatility characteristics. Joining me now, we've got Alessio De Longis, who is the Invesco head of asset allocation and senior portfolio manager. Just walk us through how you're looking at portfolio construction and positioning right now.
Thank you for having me, Brett. Yes, one typical mistake that investors do in times of uncertainty and heightened volatility is to divest and go to cash. While rule number one is really always stay invested. Over the medium and long term, staying invested is the biggest tailwind to anybody's wealth creation and portfolio return. Now, navigating that volatility, though, still requires making portfolio decisions. So one typical mistake to avoid, as I mentioned, is going from equities to cash. Well, there's alternatives to that approach to reducing portfolio risk. We like, for example, to shape that equity portfolio more into a balanced asset allocation, tilting more towards fixed income as yields rise and the economy is reaching the peak in the cycle and risks of a recession or a downturn increase. Fixed income looks more attractive. And as you mentioned, within that equity portfolio, shifting towards a defensive positioning, towards more defensive sectors with low volatility characteristics and quality characteristics, ample profit margins, low leverage. So think about your defensive tech with low volatility. Think about healthcare, consumer staples. Those are sectors that allow you to remain invested in the equity market without being as vulnerable to the shocks to the economic cycle that are instead coming from exposures that are more cyclical, such as industrials, materials, energy, and so on and so forth.
And so as we've essentially made it through 98% of the S&P 500's earnings to this point, and as we had even rounded out last week, we still do have a couple household names that are going to make their way out. What is kind of the checklist to really go down for investors to really prove how their portfolio can outlast some of the broader uncertainty that still lingers around the tariff policy?
Well, the important check is, are you, as volatility hits the market and your portfolio, are you comfortable with the type of drawdowns that you're seeing? It's important for any investor to always do a sanity check with their targeted risk tolerance and being able to navigate 1 month, 3 months, 6 months, or even 1 year drawdowns. How you react to that, it really tells you so much about the type of risk that you can take and whether you're going to be a contrarian or a momentum chaser. Diversifying the portfolio is always the most important check. I think a global balanced portfolio across equities, equity regions, fixed income, and alternatives and commodities is always the diversification is the only free lunch, really, as we like to say, available in markets. And it's important that we don't over-concentrate our bets at any given point in time.
And so with that in mind, we still do have a lot of the, not just uncertainty around tariffs, but still a little bit of not fighting the Fed, but anticipating what the Fed is going to do going forward from here. How can portfolios best reflect what is anticipated of the Fed going into the back half of the year, knowing that they're not the primary kind of driving force for the markets right now?
I think it's important for long-term investors or medium-term investors, any given Fed meeting is not going to be an appropriate reason to reposition or change a portfolio. It's about understanding where the Fed is on a broader cycle perspective. And to that end, the Fed is on a neutral holding path or cutting interest rates. So then the most important question is understanding, why is the Fed cutting rates? Because inflation is no longer high that warrants higher rates, or is because they're concerned about falling growth? The answer to that question leads to two very different portfolio outcomes. From our perspective, the Fed is here looking to ease rates because ultimately they are more concerned about faltering growth. So in that environment, learning from the Fed, understanding why the Fed is on the cyclical position that is in, should really drive portfolio decisions. Hence why we argue for a more balanced and somewhat more defensive portfolio, both in the asset allocation and in the composition of the equity portfolio.
Alessio, great to have you here with us today. Thanks so much for taking the time.
Thank you for having me.
Now time for some of today's trending tickers. We are watching Victoria's Secret and Bumble. Joining me now, we've got Yahoo Finance senior reporter Ali Canal. Ali, let's set the scene for first Victoria's Secret here. Postponing its first quarter earnings release, and this is in light of a recent security incident. The company says the incident was detected on May 24th, and as a precaution, the website was shut down on May 26th for 3 days. Functions have been mostly restored, but the restoration process has prevented employees from accessing certain systems needed for the release of results. However, the company did provide a preliminary outlook at the numbers here, and taking a look at shares, they are reacting positively, at least for right now, on these preliminary results, up by about 3%.
Yeah, and the preliminary results called for adjusted earnings of 9 cents a share on sales of $1.35 billion. This was ahead of company guidance. It's also ahead of analyst estimates. So that's boosting the share price today. Now, the company had previously said that the security incident wouldn't impact the first quarter financial results, but that's the second quarter could see higher expenses related to the breach. But it is interesting, Brad, because we've seen similar security breaches at other fashion and retail companies recently. Cartier, for example, on Monday disclosed a data breach which exposed names, email addresses, and countries of residences. So something that's certainly worth continuing to watch. I'm curious what more Victoria's Secret has to say about this breach once they do officially release those results. But we're seeing shares get a boost today. Year to date, though, still have a long way to go. We're down about 50%.
Yeah, just a reaction to some of the preliminary results coming in above that prior guidance that we were mentioning a moment ago here. Also, we're tracking Bumble on the day. Bumble falling after a downgrade to underweight from neutral at JP Morgan. The analyst writing that shares have rallied 50% since Trump's Liberation Day tariff announcements, and that the firm can't justify raising its price target given their expectations that revenue and payer declines will accelerate regardless of the macro environment. Shares are down on this by about 5% right now.
Yeah, so it's now trading above JPM's price target, so they don't really see further room to run here. They also say that revenue and user growth is expected to decline, especially among Gen Z customers, which I thought was interesting. They cut their price target to $5, and based on Monday's close, that implies about a 13% drop. And if we take a look at shares year to date, we're down over 30%. And and we'll have to wait to see if there's any other catalyst. JPM says the next possible catalyst could be Bumble's annual meeting on June 5th. But even taking a look at some of the competitors, Match Group, which owns Hinge, Tinder, their shares are also down on the year, down about 8% year to date, so still underperforming the S&P 500. But compared to where we are with Bumble, significantly better here. And I am curious how the AI story is going to continue to impact companies like Bumble, apps like Tinder, Hinge, because right now it's rough out there if you're on these apps. I have friends on them.
Yeah.
I dabble a little bit, and I don't really find them that great all the time. You have to pay in order to really get a lot out of it.
To get good quality.
It's the gamification of it all.
Gamification of finding love.
And I also feel like, now I'm just slinging my takes here.
Please, look,
but
I got coffee, I'll sit back and listen.
I also feel like that we've sort of hit peak app. And right now, people are really craving genuine in-person connections.
Yeah.
And I think that's also why we're not seeing some of these apps and websites, and therefore the stock prices not perform that well. But that's just my anecdotal research. I'll continue to explore this, but those are my hot takes.
Hard data, Bumble down 92% over the past 5 years.
Yes.
Ali, thanks so much. Appreciate it. You can scan the QR code below to track the best and worst performing stocks of the session here today with Yahoo Finance's trending tickers page. President Trump's Department of Education pausing its plans to reduce people's Social Security benefits if they have defaulted on their student loans, according to a department spokeswoman. However, the department said wage garnishment will begin later this summer. Here with more, we've got Yahoo Finance senior columnist Carrie Hannon. Carrie, what do we know about this?
Hi, Brad. Yes, so this morning, a Department of Education spokeswoman told me that, in fact, yes, they have put a pause on any garnishment of Social Security, any offsets for now. But they said they will do outreach during this time to people who are in default. And those are folks who are 270 days they've missed payments, to help them find a repayment program that will work for them. So seniors who are in default can expect to hear from them. But she did say that wage garnishment, in fact, will begin later this summer. So this is a big issue, and it got a lot of attention when they announced they were going to start taking 15% from people's Social Security monthly benefit for those in default in order to repay these loans. And something like, so many seniors really depend on, they're reliant on that monthly check. So it was quite startling. And so it's rattling, of course, but they have paused it for now.
Carrie, the Center on Budget and Policy Priorities has new data that shows recent phone service restrictions around the Social Security Administration will require over 1.93 million additional trips to field offices each year. And for many seniors, these offices are far away. Can you tell us about some of the findings there?
Oh, yeah, Brad. And this is crazy. I mean, they started all of this stuff earlier this spring, making changes to what people can and cannot do in terms of making changes to their Social Security accounts online and by telephone. They've kind of backed away from some of the things, but the one thing that they're definitely moving forward with, that is, if you need to make changes to your bank information, you do not have access to internet, then you are going to not be able to do that by telephone. You have to come to a field office to make that change in your direct deposit information or your banking information. This is very concerning for many seniors because this would require to get to a field office a round trip of an hour or so. And in fact, there's so many cutbacks in Social Security field offices right now that they're understaffed as it is. It can take 30 days to make an appointment. But the other issue is that there's something, the Center on Budget and Policy Priorities said that a quarter of seniors do live an hour away from a field office, and that 8 million seniors have disability or medical issues that make it difficult for them to travel, as well as over 6 million do not drive. So not having access, they used to be able to easily do this by telephone. And so this is an issue if you don't have internet service, which many seniors who live in rural communities don't have access to good Wi-Fi. And essentially this really creates an extra stumbling block for them.
Carrie, appreciate the breakdown on both of these stories. Coming up, we break down everything that you need to know about Broadcom ahead of the company's earnings on Thursday. That and more on the other side of the break.
It's been a roller coaster this year, but with the S&P 500 surging to within spitting distance of record highs, comparisons are popping up all over social media to the painful .com bust of 2001, and that's what we're going to look at today. I'm Jared Blickery, host of Stocks in Translation. First, let us define what a market analog is. It's an historical pattern, a market pattern that closely matches current price moves, and investors use them to possibly gauge future trends. And here's why investors are talking about the 2001 analog right now. The green line in this chart, it shows this year's market, 2025. We got a pop in January, weak February and March, then a steep sell-off in April, then the blistering May rebound. The white line is 2001, and you can see it matches pretty closely, except you're going to notice it started to roll over in late May, early June. And at the far right side, that's where it is. Critically, we have not turned down this year. Now, let's zoom out and see what happened in 2001. After that May head fake to the upside, the market turned down strongly and it kept falling, ending up 40% lower. And the pain lasted for years, as you can see in the chart. In fact, stocks did not fully recover until 2006 to 2007. But there is a big difference this time around, and check out this next chart. Unlike the start of 2001, which came after an extended decline, we began this year just off record highs. In fact, the S&P 500 started off 2001 under the 200-day moving average, and it stayed there all year long. Simply put, we have more of a cushion today than investors did back then. And here's another difference. The Fed back in 2001, the Fed was slashing rates aggressively to support the market. And guess what? Today, the Fed is stubbornly holding rates above 4%. That's actually a tougher backdrop for stocks if things indeed do turn south. So something to keep in mind there. One more thing, today's market is much more concentrated than the .com era was. The Mag 7, they are about a third of the S&P 500. Back in 2001, the top names were only about 22%. That means that things can move faster and farther in either direction if just a few big names falter or surge. So how do we know if things are really heading into 2001 style rollover? Keep it simple and watch three things. First, the S&P's 200-day moving average, now around 57.90. It is sloping upwards again, which is a big positive, but if we break decisively below, watch out. Second, earnings revisions. A wave of downgrades in early summer of 2001, that was a big red flag. And finally, third, market breadth. If you see fewer and fewer stocks holding above their 50-day moving average and then breaking below, and currently 2/3 of them are, that means the market is telling you something is wrong. So bottom line, market analogs are helpful, but they're never perfect, and they can help us stay on the right side of history if we keep them in proper context. Tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you. Earnings season is winding down, but Wall Street is still watching one big chip maker, Broadcom. The company reports Thursday after the bell. If the name Broadcom doesn't ring a bell, there's a good chance you're not alone. But let's bring everyone up to speed. You may not own any Broadcom branded products, but there's a good chance that something you use every day, your phone, laptop, or home Wi-Fi, runs on Broadcom technology. Broadcom's roots trace all the way back to 1961 when Hewlett-Packard launched a semiconductor division, a group that would help pioneer things like LED lighting, fiber optic transmitters that speed up data transfers, and most importantly, the computer chips that power modern tech. But the company we know now as Broadcom didn't officially start until 1991, when a UCLA professor and a student founded Broadcom Corporation. Their chips focused on one big thing: faster communications. Think high-speed internet, data transfers, and getting broadband into homes through cable TV. Fast forward to 2016, a company called Avago Technologies, which had acquired Hewlett-Packard's chip business, bought Broadcom. Then they took Broadcom's name, and that's why Broadcom's stock ticker is AVGO. Today, Broadcom is a global technology firm that makes chips that power things like your Wi-Fi, Bluetooth, 5G, and smartphones. Who are some of their biggest customers? Names you likely know very well: Apple, Alphabet, Meta, and Amazon. Apple alone accounts for 15% of Broadcom's revenue. And Broadcom's competitors also include names that you may recognize: Qualcomm, Intel, AMD, and NVIDIA. And while Broadcom might not be as widely known as Nvidia, it's not a small player. The company is worth more than $1 trillion, and 90% of Wall Street analysts have a buy rating on the stock, meaning they're recommending it as an investment. Coming up, we get a fresh read on the labor market this morning. I'll speak to an economist about what the print says about the economy next on Wealth. Let's get a quick check of the markets as we're just about 2 hours into today's trading session here. Taking a look at the Dow Jones Industrial Average. Yeah, we started off the day in negative territory, but ultimately we've seen some waffling and now powered higher off of the session lows, now in this ballpark of session highs here midway through the 11 a.m. hour. We'll see if we can hold on to that. We're up by about 0.25%. The NASDAQ Composite, similarly, that out of the gate was positive, then dipped negative, and now, right now, we are higher, 0.75%. And the S&P 500, some similar activity there. You're seeing that up by about 0.4%. Also want to take a look at some of the heat maps that we've got fired up here for you on the Wi-Fi Interactive. Taking a look at the sector activity, why don't we go there? Energy, you're seeing that leading the charge. It's up by about 1.5%. Real estate, pulling up the caboose. We do have more gainers than laggards as of right now here. 11 S&P 500 sectors here, so you're not going to get an even split, but you do have a split favoring the gainers as of right now, 6-5. Also taking a look at the NASDAQ 100, Nvidia, that's seeing a pop here on the day. It's up by about 3.2%. But up 0.1%, which was where my eye was going. Microsoft right now, that's up by about 0.1%. Apple seeing fractional gains, as is Amazon. However, you're seeing a little bit of declines here in the form of Alphabet. That's lower by about 1%. Meta, even despite the big deal that they announced here, where they're going to be purchasing some energy from nuclear power company Constellation Energy over the next few years. Meta Platforms, you're seeing those shares slipping just a little bit by about 0.5% here. We were breaking down Broadcom ahead of their earnings. That's to come in a few days here, and taking a look at those shares, they're up by about 2.8%, and at an all-time high, I believe that is too. So let's just take a quick look at and go back to AVGO shares here. Yes, just off of those, and let's put this on a longer term chart so you can see the past 52 weeks, past year, to see how far we've actually run over that 52-week period, up by about 93%. Okay, and just lastly, we'll take a look at the Dow 30 components on the day here. I'm just going to put this on equal so you can see how many movers to the upside and downside we have. It looks like Coca-Cola is bringing up the caboose here. That's down by about 1.8%. And yeah, Nvidia, that's still your outsized leader. Chevron, that's also just behind Nvidia in the leaders category, up 1.7%. In a sign of strength for the labor market, job openings during the month of April rose slightly to 7.39 million. That slight increase defied expectations that openings would decline slightly to 7.1 million. Here to discuss what this print signals about the health of the labor market, we've got Matt Colliar, who is the economist over at Moody's Analytics. Great to have you here with us. So just take us into your analysis of this data print.
Well, as you mentioned, it was a signal of labor market strength when we see that firms are posting more job openings than they had the month before. And like consensus forecast, which you also referenced, we expected a slight decline. The increase isn't hugely surprising. It's not representative of some kind of acceleration in the labor market. There's noise to noise, or there's month-to-month noise in any survey. JOLTS is certainly not immune from that. So slight uptick in the number of job openings, slight uptick in the number of layoffs, which is kind of contrasting signal there, but neither represent a departure from our longer-running theme that the labor market job churn is slowing.
You know, with all this in mind, we continue to hear about phantom job listings, things where companies will post a listing or a requisition, and then the intention to fill it is either slow-tracked or just doesn't fully come to fruition. I wonder here how you're looking across some of the hiring data and how much of that from the listing is actually transitioning into real hires.
It's a great question, and it was certainly prescient in 2022 when job openings surged to 12-ish million, which was by far the highest on record for this survey. So the question became, well, what's the urgency, and how do we measure urgency? A job posting is much cheaper to do now for a company than it was 20, 30 years ago even. So can you just fire a bunch of job postings online and really not track them down? Are you really trying to fill those positions? That's extremely difficult to track. But it's not. It still is a measure of labor demand, and it's largely moved directionally the way you would expect. When there was a big shortage of labor, people couldn't find people to work at the restaurants. There was a lot more job openings, and now as the economy has slowed, it corroborates with slowing job growth that we see, which we'll get on Friday, the kind of gold standard labor market data point, the jobs report. They move in the same direction, but there is this underlying concern or inability to measure urgency and the energetic degree which firms are actually trying to fill these positions, which is a knock. It's a vulnerability, and it's also a reason that a slight uptick in this morning's report shouldn't change anybody's forecast. But difficult to measure, but still a uniquely valuable data report.
Of course, not measured within this report, but Microsoft making headlines, Disney making headlines with recent layoffs this week. As you're thinking through some of these major announcements from the private sector and household names, what does this kind of read through translate to for layoffs that not just were reported within this print, but also those that are coming in the future?
Well, we look at macro factors and we say these are the things that we're lining up, and they all point to a slowdown in hiring. If I don't know I never know exactly what the world's going to look like in 3 months, but if consumers are telling me that they think there's going to be a recession in 3 months, then they're likely to pull back on that vacation, or maybe we fix the washer and dryer, we don't buy one. That's less demand for big box retailers, for recreational activities, airlines. All of that stuff is the kind of things that precede layoffs. So we look at those factors rather than, although we're certainly available or aware of company-specific announcements. But we look at those factors and we say, okay, these are the things that we think lead to firms having less demand for hiring, and we're going to wait and see when that starts to show up. And the most timely measure we look at right now comes out each Thursday morning from the U.S. government. It's the number of weekly filers for unemployment insurance claims. That's kind of broadly assumed to be the canary in the coal mine. If we start to see those layoffs manifest in a macro sense, it's not just specific companies, but this is happening broadly. We look at the number of claims for unemployment insurance. If that gets off its 220,000 level that it's been for a while and starts to drift into the 250, 275,000 per week on a sustained basis, that's a different labor market. And that's what we're looking at. We see a little bit of a drift upward, but largely it's still been a story of resilience for the U.S. labor market.
Moody's Analytics economist Matt Collier, thanks so much for taking the time.
Thank you.
Coming up, the mistakes keeping you from saving smart and building wealth. Plus, how to do a mid-year audit of your spending that will get your budget ready for that summer vacation. That's on the other side of this short break. According to the 2025 Mind Over Money study by Capital One and the Decision Lab, a majority of Americans are concerned about not having enough money, especially when it comes to saving for retirement and the rising cost of living. My next guest says that there are some key mistakes that can get in the way of building wealth. I want to bring in Brennan Schlagbaum, who is the Budget Dog founder and personal finance expert. Brennan, good to have you here with us. You say waiting to start investing, keeping cash idle, ignoring fees, underestimating healthcare costs, and holding too much cash can be risky. So let's break these down one by one. Let's start with waiting to start investing. Why is that one of the top mistakes you see?
The biggest myth I hear is I'll start investing when I make more money. But the truth is, wealth is created by starting early. So the whole key is to start early, and small amounts really compound. The biggest wealth building factor by far is time. So waiting costs you time, and time is one of those things you just can't buy back, unfortunately. I wish you could.
Oh, me too. So why should you avoid keeping cash idle? This is another mistake that you see.
So as you guys know, most banks are offering, 0.00001%. So you can easily move that cash into a high yield savings account. Things like Ally, things like Marcus by Goldman Sachs. And there's not really additional risk, and it's really easy optimization. So it's a no-brainer move for anybody out there holding cash in a typical checking account.
Now, there's the conversation of fees that catch a lot of people by surprise. Why should investors pay close attention to fees?
So fees may look small. You might have a 0.5% there, you might have 1% there, But over 30 years, the reality is that 6 to 7 figures, and these are things like expense ratios, AUM fees, back-end load fees, transaction fees, and you wouldn't overpay for groceries, so why would you overpay for retirement? Let's focus on low-cost index funds and ETFs and just watch our investments grow fee-free in the most easy way possible.
And so one of the other things that we hear far too often, especially those who are close to nearing retirement or in retirement, risks of underestimating healthcare costs. What do you see there? How can you kind of flip that on its head and reverse it and set better strategies?
Yeah, so healthcare is one of those big, hairy things that are 30 years in the future. So most of us don't think about this, but the reality is it's one of the biggest expenses in retirement, and people underestimate this. And I know from a personal situation how much healthcare costs can be because my daughter's situation. She has Dravet syndrome, and these bills have totaled over $200,000 per year the last 3 years. She's only 3 years old. And plot twist, Medicare doesn't cover everything. So things like long-term care, dental, vision, out-of-pocket costs, unfortunately, that's not covered. So you need to have planning ahead with an HSA or something like that. So when the time comes, you have the money to take care of yourself and your family.
Yeah, very key reminder there. Finally here, while we have you, why should you avoid holding too much cash?
Yeah, so with inflation, I don't think that's a secret at this point in time. Uninvested cash loses purchasing power every single year. And most people think this is safe, keeping money in a checking account like we talked about, but over 10 to 20 years, this is a real wealth killer. And the crazy thing is, $100,000 in 2020 or in the year 2000 is now $187,000 today. So the cost of inaction, the cost of doing nothing is costing more than it's ever been before.
Brennan, thanks for taking the time here with us today. Really appreciate the breakdown. Hopefully we can use some of these mistakes that you've seen to course correct for some other folks viewing out there. Appreciate it.
Thank you.
All week long on Wealth, we're conducting your mid-year financial checkup. If you're one of the Americans who wanted to save more or spend less in 2025, you set this at the outset of the year as one of your goals, well, guess what? This is your opportunity for a progress report. I'm joined in studio by Bobby Rebell, who is the cardrates.com CFP and personal finance expert. Bobby, good to have you here in studio with us. So let's talk about these mid-year check-ins. How can a mid-year check-in, an audit, how can this help with some of your spending habits?
Okay, well, the first thing you want to do is you want to look back at your history, because we learned so much from history, we know. So you want to look at not your New Year's resolutions, Brad. You want to look at your New Year's expectations and think about how you did relative to that. So look at how you did in terms of your income. What were you expecting? Did you expect to get a raise? Maybe you got it, maybe you didn't. Did you expect to earn money in overtime? How did your actual earning come in based on your expectations? And then you want to think about how your spending went. What were your expenses? Were they higher than expected? Did you have some surprises? And of course, think about where you are in terms of your debt. Did you make the kind of progress that you would hope to make? And finally, savings and investments. So take a holistic point of view.
So once you take that in, what do you do with that information?
You need to analyze it. You need to actually take the time. I know we talk about being mindful with our money these days, and I talk about financial wellness a lot. But the truth is that really matters, taking the time to assess how you did. And the interesting thing is there are some things we can control and some things we can't control. So think about what you could control in terms of your income, right? How did you do? Did you take the time to ask for that raise? Did you offer to work the overtime? Did you really get going on that side hustle? How did that income come, and what did you have control of? And the same thing with the spending. Did you get pulled into spending on things that maybe you regret a little bit? But also, I think people should give themselves a little bit of a break. This year's been tough. There's a lot of things that hit us that were not in our control. So we need to give ourselves a little love and remember things like inflation, things costing more. We couldn't control that. Think about, though, what you could do differently.
That's why I needed to go to that Beyonce concert. It just had to happen, even though it would have been overspending by normal years. But how do you adjust and pull back from overspending and course correct?
Yeah, so you want to really think about how you're spending. Think about why you're spending. So you had to go to the Beyonce concert. You had to. And you know, we can talk about how you manage your summer spending, how you might think about your priorities, but really think through what you can do to take better control and spend more deliberately. So that might mean little, tricks and tips. So write down your budget, put it somewhere where you can see it, but then take it a step further. I like to think about renewing your budget vows. So you put maybe on your refrigerator, whatever it is, your spending plan, your budget, what you have, and then you get used to it. So you don't really see it anymore. Take it down once a week, once every 2 weeks, put it in your calendar as a reminder, rewrite it, adjust it. constantly rework it because life happens and it may not be realistic anymore. So constantly check in with that. You also might want to do some little tips and tricks like when you're shopping online, put your stuff in your wish list, not your cart. It's one extra step. Remove that credit card from inside your, when your computer remembers it. You know how that is. You want to remove that. Wait to make those purchases. And of course, unsubscribe to those retailers who love to remind you that every day is the best sale ever. Every day is your last chance to get that deal that you know you want to get. And I also say, shop your closet and your home. Not just clothing. We tend to buy things that we already have in our home just because we can't find it. So It makes sense to get organized. And then, we talked about the work-in, that Walmart Birkin.
Yeah.
It's not a bad thing to buy a dupe. Own it.
It's okay. Fact. Yeah, you got a lot of good vendors on Canal Street who could sell you a dupe for sure here.
Yeah, well, those are forgeries. We're talking legit dupes. We're keeping it above board, legal, inspired by.
Generalizing too much,
inspired
perhaps.
by, yes.
Inspired by. How do you leave room in your budget for those summer vacations and other fun activities?
Like Beyonce concerts.
Like that.
Right. So you want to think about your priorities and really write them down and think about where do you get the best bang for your buck. And it might be one giant splurge event, like, a Taylor Swift or a Beyonce concert, and that may be it. And then, you can just say, what's the best value for the money in the summer? Being lazy. Just chill with your friends. It's okay to spend less and really make sure that you find a way to get the things that matter the most to you.
Absolutely.
Like
Bobby.
Beyonce.
Exactly.
It's all about Beyonce today.
Exactly. The she economy powered by Beyonce. Thank you so much for joining us.
Thanks for having me.
Coming up, everyone, we get the pros and cons of using an annuity in your retirement planning. That's next on Wealth. In 2024, annuity sales rose 13% from the year prior, reaching $434 billion, according to research and consulting organization LIMRA. The firm says favorable economic conditions and growing investor awareness around annuities helped propel that growth. But our next guest says that annuities are not for everyone. Here with more, we've got John Shrewsbury, who is the Gen Wealth Financial Advisors co-owner and managing principal. John, good to have you here with us. So let's start with exactly what annuities are for those who are not exposed.
So an annuity is a contract with an insurance company, and what you're contracting to do with that insurance company is to provide you a regular, predictable stream of income during retirement. I say annuities are not for everyone because if you're not heading toward retirement or in retirement, you probably don't need that. But an annuity is the only investment vehicle that can transfer the risk of a regular, predictable stream of income that you can't outlive to a well-capitalized insurance company, and it allows you to create a stream of income very similar to a pension or a Social Security check that we think about as foundational income for someone as they try to meet their basic living expenses with guaranteed income sources.
Okay, and so that starts to get at who annuities could be good for. What are some of the pros there, and who could it be good for ultimately?
So we normally see the use of annuities with people who are very close to retirement or already in retirement. What they're trying to do is they're trying to build that foundation of income. You know, if you just think about a personal balance sheet of your monthly liabilities, your electric bill, your mortgage, your food bill, all of those things are regular, predictable expenses that you're going to have. We believe that that ought to be met by regular, predictable income. Most people have one source of regular, predictable income in their life, and that's Social Security. They may have a pension, but there's about 12% of the population that actually has a pension. Other than that, the sources of income are not guaranteed unless you utilize an annuity, and that's where an annuity fits best. Annuities are not for everybody. I know that there's a lot of people that sell annuities because they have an insurance license to do so, and they are made out to be something of the Swiss Army knife of all kinds of investments. But really and truly, an annuity is a retirement vehicle that produces income.
And so you started to hit on this a little bit, but what are the cons of annuities?
Yeah, an annuity contract doesn't really have what I call a personality. It doesn't act a certain way. Mostly it's a tool, and if that tool is used the right way, it can be great. But if that tool is used the wrong way, then it can be a problem. For instance, there is a penalty for early withdrawal of income from an annuity prior to age 59 and a half, much like an IRA account. So you would want to avoid an annuity if you need income from an investment prior to age 59 and a half. Annuities do grow on a tax-deferred basis, but there is a commitment in making an investment into an annuity. You don't put money into an annuity to later think about, oh, I'm going to take that and do something else. What you're really doing is you're buying yourself a stream of steady income for retirement. If it's used for almost anything else, then it's probably going to be problematical, with the exception of sort of a new age of annuity products called registered index-linked annuities. Those annuities can buffer downside risk in the market for long-term investors who really want to be sure that they arrive at a certain spot in their life with a certain amount of money. Those RILA contracts can be designed to actually do that during the accumulation phase of your wealth program.
Okay, and so if you are speaking with an agent that can sell you an annuity, what are the top questions that you should be asking?
I think, first of all, you have to ask yourself, do I have a gap in income? Do I have a need for another stream of regular, predictable, dependable income? If the answer to that is yes, then the answer could be an annuity. You need to talk through all of the fees and administrative charges that may be attached to a particular annuity, understand how it works, understand what's going to be left if you die prematurely, understand that income will last you the rest of your life, but does it take care of your spouse? There's a lot of complexity to that, and that's why we say that much like prescriptions are the territory of a doctor, then an annuity really needs to be administered by a registered investment advisor that understands the full picture of the client's financial situation and can prescribe the type of annuity that works best for them.
When do you know, and we only have 30 seconds left here, but on the commission structure, when do you know that someone's just trying to take advantage of you?
Well, I think if they're trying to fit a square peg in a round hole, if there's some story that they're giving you that doesn't quite fit with your situation, then that may be a red flag that you're trying to be sold something as opposed to use a tool that actually helps you in your overall financial plan.
John, good to have you here with us today. Thanks so much for taking the time.
Thanks.
Let's do a final check of the markets as we're taking a look at the major averages. As of right now, we are higher across the board. Fractional gains for the Dow, the S&P 500, and the NASDAQ. The NASDAQ leading on a percentage and point basis right now, up by about 0.7%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.